Hi, I'm Rory Johnston, Commodity Economist at Scotiabank. Global oil prices have firmed up, and the Alberta government's curtailment program has helped ease the acute discounts that plagued Western Canadian crude prices through last year. There are further upside risks to current global prices owing to new sanctions on Iran, Venezuela's accelerating collapse, and renewed fighting in Libya. However, we maintain our forecast that WTI will remain around $60 per barrel this year and next. OPEC has enough spare production capacity to compensate for most of these scenarios, and US shale continues to see strong growth. Unfortunately, Canada's oil patch still faces serious pipeline shortages. Line 3's delay further extends Western Canada's dependence on oil by rail through next year, but it's tough for that rail capacity to expand with today's relatively tight differentials. We expect that the WCS discount to WTI will widen to more than $20 per barrel through the second half of 2019 and into 2020 as curtailment is further relaxed.
Hi, I'm Marc Desormeaux, Provincial Economist at Scotiabank. Economy-wide real GDP growth is expected to slow in Alberta from 2.1% in 2018 to 1.2% in 2019, owing to government-mandated cuts in oil production, Line 3's construction delays, and expected restraint in provincial government spending. Labor market prospects are also relatively muted, with Alberta projected to register the third weakest gains in jobs this year. We look for activity to rebound to about 2.5% growth in 2020 as work progresses on petrochemicals facilities, a potato processing plant, and the ongoing diversification of Alberta's urban economies. That would make Alberta the second fastest growing economy in Canada, but it would still be well below the 5% gains the province saw following the 2008 recession. Despite a recent return of net migration into the province, Alberta's cities have accrued substantial inventories of unsold homes since the last major commodity price correction in 2014. A marked rebound in home prices and construction activity, therefore, remains at least a year off.
Hello, I'm Brett House, Deputy Chief Economist at Scotiabank. Rory and Marc have outlined our expectations for oil and Alberta's economy. In both cases, our outlook acknowledges some near-term softness and anticipates better activity as we head into the second half of 2019 and onward into 2020. This mirrors our forecasts for Canada more broadly. While we ended 2018 on a weak note, data so far in 2019 imply that talk of a looming recession was overblown, and that growth should accelerate from 1.5% in 2019 to around 2% in 2020. In the midst of this, the Canadian consumer remains resilient. Tight labor markets and rising wages are compensating for higher interest rates. Households continue to borrow, supported by strong balance sheets that feature solid asset positions. Unfilled order books on the industrial side are near 4-year highs. As a result, we expect business investment to increase in 2020. And with US growth set to outpace Canadian activity this year, trade should contribute more to Canadian growth as global tensions on this front ease. As a result, we don't see rate cuts ahead from either the Bank of Canada or the Fed. And the Canadian dollar should strengthen mildly against the greenback over the next couple years as the US twin fiscal and trade deficits start to weigh on the US dollar and oil prices lend a bit of lift to the loonie. You can find more economic research and analysis from Scotiabank on our website, and you can also follow us on Twitter as well as on LinkedIn. On behalf of Rory Johnston, Marc Desormeaux, and our entire team at Scotiabank Economics, thanks for watching.